Welcome to the next video in the series, and I'm going to be doing one on Deutsche Bank, and in particular I'm going to be focusing on one aspect that I think is of quite considerable importance. It tends to be ignored by many analysts and the mainstream media. Now, what's been the news is effectively that Deutsche Bank's stock price has declined from 140 euros at its peak to €6.20, €6.30 currently. But it's not just the stock price fall that is of concern, it's the viability of Deutsche Bank going forward and the potential for Deutsche Bank's derivative portfolio to cause major systemic problems. So I'm going to use this video to highlight a major problem, and there's many factors that I think Deutsche Bank, you could literally write a book on it, the problems of it, and there has been several books written on it. But if this bank goes down, which for reasons I will explain, it might be difficult for that to happen, it would be an event that would be 20 times worse than Lehman's because of the systemic problems that it would cause. Now let me explain this. The current focus on the stock price is misleading. The German government could easily top up the bank's balance sheet, which currently is around $23 billion. But if that were the case, then the stock price wouldn't have declined so rapidly, and it certainly wouldn't have stayed at the current levels, because a rumour of the German government investing in the bank or adding extra capital would certainly pump the stock price up. But it's not happening, so there's much deeper problems, and this is what I'll go into later on in the video. So where the government would have problems is if the bank starts to topple. It has a massive derivatives holding, and if this were to start to unravel, it would cause major significant global financial problems. So the real crisis, if we go back in history, the real crisis of the Lehman's debacle was the underlying derivatives, where banks did not know, when everything unfolded, the banks did not know where they were on a credit basis with their counterparties. So there was a credit risk exposure that basically froze up the banking system, because banks literally didn't know who was going to be around tomorrow, and you weren't going to trade with a bank that you weren't sure of if it was going to exist. So that and also banks don't want to trade with a bank that has weak counterparty credit, simply because the possibility of their own bank balance sheet shrinking. So it's really a survival of the fittest side of things, and as I say, hence the freeze in 2008. So I'm going to look at a potential derivatives nightmare, but before I actually start that, what I want to do is I want to define what a derivative is. And as far as we're concerned, the vast majority of derivatives that are traded on an interbank basis are interest rate derivatives, and namely swaps. So an interest rate derivative is a derivative where the underlying asset is the right to pay or receive a usually notional amount of money at a given interest rate. So basically, when we can see that there's an underlying asset, there's the right to pay or receive funds based on usually a notional amount at a given interest rate. So you can see in this definition that there's a term notional that's been introduced, and this is crucial to keep in mind as we go forward, because Deutsche Bank's outstanding derivative portfolio stands at 43 trillion, yes, $43 trillion. That's twice the size of the US GDP, and approximately 90% of those are interest rate derivatives, and as I said, the majority of those being swaps. Now, it's a good place here to go over what notional means, and we're going to work with an example basically to show you how notional works and how a derivative works. So let's just say, for example, we've got Bank A and Bank B, and they want to speculate on what they feel is going to be a 0.5% movement in the interest rate over the next year. And so what they do is as follows. So Bank A believes that the rates are going to go up, Bank B believes rates are going to go down, and then Banks A and B agree to price the interest rate movement over a year using a notional US dollar amount of 10 million. So basically what this does is this leverages up the amount of the transaction to give a reasonable profit for either bank. using the power of leverage. And so the banks do the following. What they do is they use a central counterparty clearinghouse, which is abbreviated to a CCP. And basically, this is where the mechanics allowing such large transactions occur, and it's basically able to be done because there's a thing called set-off, a legal term called set-off, and there is an ability where there is a legal jurisdiction that allows set-off to occur. Then you can use what's called a master netting agreement, which basically means that Bank A and Bank B, using this master netting agreement, can have the CCP eliminate the notional amount of the contract, and basically what they're left with is either the profit or loss for each bank. But in order to do this, collateral is needed to be able to put into a margin account effectively with the clearinghouse. So this allows the set-off to occur because it's a legally liable, it's a legal liability on the counterparty to settle the notional amount. And the collateral is used to create what's called a default buffer, and in particular a waterfall default, a default waterfall. And we're going to go into this later on in the video. And so basically what we're looking at doing is examining now what a CCP's role is and how the liability goes forward with the CCP. Now there are three main central counterparty clearinghouses, and these are LCH, CME and ICE. And the function of the CCP is to stand between the counterparties and basically provide liquidity by using set-off to match the notional amounts, the notional values of the derivatives, and basically leave a net amount for the profit or loss of the particular banks, like Bank A or B, which I described before. So the main purpose of the CCP is to ensure liquidity in a smooth transactional process of the whole massive derivative market, which is over 540 trillion according to the BIS as we speak. Now, another function in making sure there's liquidity is the purpose of the CCP is if there's a default by a member of the CCP, and the CCP is got multiple banks as members effectively, which are then able to trade within that CCP. But if there's a default, then there's a series of what you could almost call margin calls within the CCP, and this is called the default waterfall. Now, the example in front of you is the default waterfall for the LCH CCP, and even going forward, as you'll see later in this video, I believe that there's an absolute lack of collateral within the CCP system, which I'll show you, which makes it very vulnerable to a systemic shock. So what you see in front of you is the default waterfall, and let me explain a bit about it because it's quite important to understand what goes on with the CCP. Now, as you can see, the second column, it shows the defaults applicable for a member default with an interest rate derivative. So each one of these columns has got a specific type of derivative, and the second column is for interest rate derivatives. And on the legend on the right hand side, you can see there's 159 billion available of contribution margin. Now this represents the total pool of collateral by all members for default of one or more of their co-members. Now initially the defaulting member's collateral margin is eaten up, then it comes from the pool, and next comes LCH's capital, then the rate derivatives default fund at 5 billion. So what I want you to do is I want you to look at the bottom entry, and that's the Armageddon moment when a CCP closes, when a rate derivative service, as it says, rate derivative service closure, it's gone, it's bankrupt. Now, can this happen? Well, one or two almost did, and what I want to do is I want you to look at the following information on two CCPs in the last quarter of 2018. So if we look at the subtitle here, we see Nasdaq and ICE breaches carry warnings for the market. So let me read the really important parts for you to basically see why I think CCPs are potentially really vulnerable in the crisis. So two recent episodes have shed some light on how this works in practice. Last September, Nasdaq Commodities consumed 114 million, $131 million to plug the default of a single trader, Einar As. Of that total, 7 million euros was a slice of the CCP's own capital, and this is quite important. And the rest came from its default fund, so this is the contribution, collateral contribution that the other co-members made towards a default of another member. Last-ditch reserves contributed by each member. Now, fresh insights on the episode can be found in recent disclosures. These reveal that in the third quarter, Nasdaq Commodities incurred a peak margin breach, which at 23 million euros was over 7 times larger than any previously reported. It's likely this was the breach that AS was unable to cover, which cost Nasdaq and its members so much. Now, this is interesting because let's actually have a look from the BIS chart of this particular default. You can see Einar, the initial margin, and the AS default contribution. The collateral isn't actually common knowledge. It's something that was obviously between the CCP and the counterparties. But what we do know is that the Nasdaq contribution margin was exhausted at 7 million. And the total contribution margin, the total contributions of members towards a default, which was at 166 million euros, 107 million of those euros was taken in the default. So basically, that's where we come at the 114 million euros in the previous slide of what that default cost. Basically, 19 million and 45 million euros of that particular default waterfall was not used, so therefore the CCP did not go broke. Now, so what you can see is the total capital was eaten up by the default via this Nasdaq default waterfall. Now, later in the article, it mentions before it says that the total default represented 5% of the margin pull. Now, what I want you to do is I want you to think about that. The margin pull from the previous slide shows 166 million euros. This means that if we apply a 5% calculation of that 166 million euros, we arrive at a figure of about 8.3. Now, this is conjecture. It's not necessarily known, so I'm just guessing at this. So effectively, a default of 8.3 million euros caused a margin call on the CCP of 114 million. And if you look at it, that's a default. That's a ratio of 14. Now, this blowout from 8.3 to 114 is because derivatives are highly leveraged on capital. So it doesn't make on collateral. So it doesn't make much of a default to bring the whole house down. And this is why I mentioned that I think the collateral set-asides are wholly inadequate for CCPs if the proverbial S hits the fan. So what I want to do is, this particular article also goes on to say here, and it's quite important to read here regarding this Einar As failure. Viewed another way, however, the twin episodes are less reassuring. Nasdaq's default fund is supposed to be able to withstand the collapse of its two largest members, but As was no whale, and he still nearly took the whole ship down with him. So perhaps because the large illiquid positions proved difficult to auction off, the defaulted portfolio itself represents less than 5% of the total initial margin pull for the commodity clearing service. Had it been larger, and this is very, very important, had it been larger, the default fund could have been depleted entirely. So this goes to show about the 5% that I mentioned, the 114 million, and the leverage. So what they're saying here is, you know, this could have been curtains, and it's not a large amount. It's not a large amount. So another thing that we have to consider is that there was also a major default that particular quarter as well, and it had to do with the ICE CCP, and that was a 1.82 billion default, and that was a major default. Luckily for the system, before it went outside of the system, that was internally able to be sorted. So what we see is, we basically see that there was a lucky escape that two CCPs in the same quarter didn't go down. One was a relatively small position that went bad, and the other was a larger position, but luckily the resources of the contribution margin of ICE was more than adequate for it. So ultimately both counterparties weathered the storm. But here's something here that it says here in this particular article as well. Over at ICE, the member appears, as I said, to have been carrying enough cash to top up its margin. Hopefully the CCP itself was confident that would be the case. But here's the question, and this is what I've been sort of like outlining to you. What if there had been a shortfall? Then ICE would have faced the challenge of closing out a huge directional portfolio at a time when many of its members were grappling with their own spiralling market exposures, as evidenced by the number of breaches reporting at the clearinghouse in the third quarter. So there's a very great fragility in these clearinghouses when it comes to a derivative contract or numbers of derivative contracts, especially that are illiquid, going bad. And it doesn't take much, as I've shown. Now, to further enhance this, on page 7 of a working paper done for the IMF in October 2018, which is fairly recent, the authors Dermot Turing and Manmohan Singh said, basically, and this is a long one but bear with me, beginning with the CCP's actions in managing a particularly difficult default, a CCP is obliged to try re-establish a match book in respect of trades in the defaulter's account by arranging the auction and transfer, where the auction is successful, of the defaulter's transactions to non-defaulting clearing members, and disposal of collateral into the market. And this is the key sentence. However, in a very difficult default, it is not a given that these processes will have a successful outcome. A successful auction will depend on the bidders making realistic bids, which might not happen in stressed market conditions, or the bids may be so far away from the CCP's view of what is expected that the best bid is not accepted. Such an outcome implies that the entire default waterfall of the CCP is at risk. The best bids received may exceed the available resources. The CCP may have to find alternative ways of holding the defaulter's position while maintaining its own obligations to surviving clearing members. Now, we're talking now after a default of all of a sudden surviving clearing members, but these clearing members can be big banks like Deutsche Bank, Wells Fargo, Citibank. These are major players. So can you imagine the absolute turmoil if a counterparty goes down within the CCP with auctions, trying to do auctions? It's a nightmare, because that's how the notional amounts are transferred through the system, is by auction. So we can see that there's a major potential problem going forward. Now, this was highlighted by back in September 29, 2010 with Lloyd Blankfein, who's the CEO of Goldman Sachs. And he basically said, I agree that clearinghouses make things less risky for the regular crisis, but in an extreme crisis that could affect the clearinghouse itself, it's dramatically more risky. And basically what he's saying, if without further, even with Dodd-Frank, without further collateral and strengthening of the CCPs, he goes on to say, otherwise the clearinghouse becomes the biggest systemic risk in the world. So this just clarifies, I mean, it's Lloyd Blankfein, CEO of Goldman Sachs, a really smart guy, has also said that these are a problem. So basically, what has this got to do with Deutsche Bank? Everything. Let's look at the following slide. Yes, I know it shows derivatives from 2008 from Goldman Sachs, but what I'm trying to demonstrate here is the web of cross-fertilization, of cross deals that are apparent in this particular mode of operation of derivatives. And you can see how connected the banks are and the size of the notional exposures to each. I mean, basically, what you have to do is look at the interest rate products, 13.2 trillion. Look at the players. Deutsche Bank, 1.24 trillion. JP Morgan, nearly 2 trillion. Merrill Lynch, 1.13 trillion. Obviously, Lehman Brothers disappeared in this time of thing, but they're 1.26 trillion. Royal Bank of Scotland, 2 trillion. So you can see the total interconnectedness of this whole system. So it's no wonder that if Deutsche Bank goes down, bang, the whole system goes with it. So because what I've said before, even a small amount of 8.3 million euros can upset a CCP. That effectively means that the whole liquidity sphere disappears. So let's even look at a major thing. Why is this occurs? Because in the BIS side of things, they say that the net liability of 543 trillion euros is 1.8 trillion. But if the CCPs go down because of the auction process, it's much, much larger, because the notional amount has to be bid for with the other counterparties, and that's if any of them are surviving. So the 1.8 trillion doesn't become a netted amount of the difference between what's called gross profit fair value, future value, and gross negative future value. That's it. It doesn't exist. The liability exists to be auctioned on, and that's where the whole system fails basically, and that's why the whole system would freeze up. So basically, the CCP is to socialise the default of one or two members, potentially big members, but once it starts to go into contagion side of things, it's finished. So with just one wheel in the cog, the CCPs going under, with a counterparty going under, which is a major bank, bang, it's gone. Now, I'm not saying that Deutsche Bank, for example, is the one that's going to cause the crash, but it's very weak. It doesn't have income in terms of the other banks. Its derivatives books looks very, well, I don't know the ins and outs of it, but it doesn't look that great. And Deutsche Bank is not able at the moment to basically trim in fast enough some of those derivative positions. So Deutsche Bank, if it fails, I mean, it's almost irrelevant what happens. We'll see the biggest credit crunch, the credit squeeze that we've ever seen. So that's why the market is extremely nervous about what would happen to Deutsche Bank. Yes, the stock price does reflect this, but behind the scenes, those people that are in the know that with the interconnectedness of the counterparties with the clearing houses, and if they go down, it's game over. So keep watching the banks, keep watching derivatives, keep watching in particular interest rates if they move savagely up or down, because this could be a great indicator of massive problems to come, and obviously I don't want that, and I'm sure you don't want that, but you do have to keep an eye on it, because it's going to have a major effect on your investments going forward. Thank you for watching the video, and I look forward to the next one. Bye.